This is King World News. I'm Eric King, and you're about to hear an interview with an incredible lady and really quite legendary for her technical work on Wall Street, Louise Yamada. Remember to go to our homepage at www.kingworldnews.com for more interviews, where this week we also have John Hathaway, Chief Portfolio Manager for all of the Tocqueville funds, as well as Michael Lewitt, founder of Harsh Capital Management. We also have John Duty and John Rubino as special guests in the Gold Plus broadcast section, along with Ted Butler and Gata. Joining us now is Louise Yamada from Technical Research Advisors. Louise, last time we went to have you on, we had a technical problem, and I thought there was going to be an internet riot or something because so many people were trying to figure out how they could access your interview.
Oh, dear.
Yeah, it was hysterical. There was just tremendous demand for you to be on the air. So fortunately, we have you back here. And actually, the timing of this is actually quite nice, and we'll cover that at the end. We'll save that to the end of the interview. To start off here, though, Louise, you've had such a really, I want to say, a storied career. It's been amazing. You're sort of legendary on Wall Street, and to accomplish everything that you've done in your career, I think is so amazing. And I just want to give the listeners a little bit of a chance today to look at some of the calls that you've made, maybe things that they weren't even aware of. And I'd like to start off with one right out of the gate, if you don't mind, and then we'll move on to stock market, bonds, and get your take on everything. But you really did make an amazing call in 1995. You said basically that water would be the way to go, and that was back when basically nobody was looking at this at all, Louise. How did you know to make that call?
Well, it was sort of just a conceptual thought that came in line with a lot of other observations that we were making in terms of some of the charts, particularly some of the commodities, although they pulled back once again, and recognizing that commodities utilize 87% of the world's fresh water. I just went to the UN and got a report on water, and apart from some of the small little articles I'd seen, it was a rather shocking report. And I felt that it was extremely important and that we were going to be looking at water as the commodity of the 21st century. At that point, I think you were paying more for a gallon of water than you were for a gallon of gas. Not today, but back then you were.
Well, you say you just went to go get a report from the UN. Nobody else did that, I don't think, and then wrote it up. So I guess you kind of brush it off. But it really was, Louise, that was an amazing call. I don't have an idea, and I hate to put you on the spot here, but what kind of multiples are things up from the time that you recommended it back in 1995? I mean, it has to be almost astronomical. Can you even quantify it?
I can't. I would have to go back and look at what we were looking at, but probably a lot of the agricultural stocks and the stocks like Deere and Caterpillar and things that were related to agriculture, and of Valmont Industries, which was doing pivot irrigation, along with Lindsay Manufacturing. Some of them have had some good runs.
Let's move on to, if you don't mind, gold. I'd just like to get into gold because really you were on this back in 2002. Gold was under $300, right?
Correct.
And for some reason, Louise Yamada says, it's time to buy gold, or we need to look at gold. Again, what were you looking at that made you, because I know you're not really a fundamentalist, so that's why I'm asking you.
No, and that was all technical, Eric, to be perfectly honest with you. We were starting to see a turn up from a slightly higher low in the price of gold that seemed to be tracing out a 5-year saucer bottom. And we suggested that if it could get up and break through 300, that it would violate the long-term downtrend, 20-plus year downtrend off the 1980-81 peak, and would initiate what we felt was a new structural bull market. And we've had progressively higher targets from that point forward.
What do you see going forward, Louise, for gold? Just secular bull market time according to the chart?
Well, that's part of it. It is a secular bull market time in terms of the charts because we really saw several structural long-term trend reversals taking place in that period of time. If we think back to 2000, we saw the first violation of the 18-year uptrend in the equity market. That was one structural reversal that hadn't happened since 1982. Gold was another one. Didn't happen since the 1980s. So, yes, we felt that we were seeing a series of structural evolutions taking place in terms of reversing long-term trends. And now I think you have gold, having lifted through this 18-month consolidation, is probably on its way to 2,000. Our interim targets are about, I think, 1180 and then 1,300 and then 1,550, but there are a number of technical studies that one can do to get you to 2,000 and even higher. Obviously, fools shouldn't rush in. It's a question of recognizing the continuation of a progression of higher lows, which represents demand, and higher highs as the price moves up. And so far, we've had this 7 to 8 year uptrend in gold, which has maintained. And now with the recent breakout, we're extending that uptrend, so to speak, and have the potential for some of those higher targets to come to fruition.
You make an interesting point. Fools shouldn't rush in, but I've said for years on the air that if you make, let's say somebody went and bought gold and they did it now and it had a pullback. I mean, the reality is, Louise, if you're buying quality, in this case gold being quality because it's not a stock where it can have a country take away mining rights or something of that nature, but the bull market will rescue you even if you're making a bad entry point as long as you're buying quality, correct?
As long as that quality remains in an uptrend, Eric, is how I would quantify that technically, because the uptrend is the evidence that there is continued demand coming into place for whatever it is. Recognize that the Nifty 50s were quality stocks in the 1960s, late 60s, and yet you saw stocks like then Avon Products go from 200 to 19. So it was at the time quality, but it had become over-owned. So anything that's in a long-term structural uptrend can at some point and will inevitably become over-owned, and somebody out there will start selling, at which point you start to see the distribution or the failure to go to new highs and eventually the evolution of a slightly lower low, which is what happened with equities in 2000, March of 2000, the first point in 18 years that we actually saw a lower low take hold, along with a lot of other technical evidence that the top was coming into place. Now, saying, fools should not rush in lightly, the point is that if gold were to break down to a new low, then one obviously has to protect one's capital and recognize that the supply and demand factors have shifted away from demand and more towards supply for anything, for a stock, for a commodity, for futures. Anything at all.
Just very quickly on this, Louise, in your opinion, I'm asking you to speculate a little bit, but if you're looking at the gold market, and let's say there's 3 phases to a bull market. Let's use Richard Russell's model where he says you have phase 1, 2, and then 3 where you have the mania.
The 3 waves up.
Yeah, would you say, I don't want to color your opinion here, but are we in phase 2, early phase of phase 2, middle of phase 2? Can you give me an idea of just if you had to guess here? Because we're seeing institutional money come in now with the green light capitals, et cetera, that have come into gold, the insurance companies, these big institutions that are sort of, I guess, coming in ahead of the game, I think, to some degree, but getting involved in the gold market, and that's natural during a secular bull market. Where are we on the phases, would you say?
I think that perhaps we could argue that we're in the second major leg up because this 18-month consolidation is impressive, and it was the first of that longevity, so to speak. And so we may well be in the second phase up, or second leg up, so to speak. And somewhere down the road there'll be another consolidation or pullback of some sort. And then you'll get into what could develop into a manic phase eventually, or a blow-off phase, the way it happened for gold in the 1980-81.
We'll look, obviously, at the stock market and some of these other things, but before we move on, with regards to energy and the CRB in 2004, again, you sort of nailed that. We're looking for $60, I think $70 a barrel oil. That's exactly what happened. Then we had the pullback and then the explosion. What are your thoughts now when you look at energy? I'm just curious on what you see.
Well, I think that we have to recognize that the targets we had toward 80 and higher, we actually had one at 140-something, were achieved much sooner than one would have expected. I mean, usually a short-term period of time will achieve a short-term target. Intermediate-term period of time, you reach the slightly higher target. And over a much longer period of time, months to years, you achieve your ultimate target, so to speak. And I would suggest that the 30 to 40 times leverage that was allowed or permitted after 2004 really allowed the markets to go much farther on speculative activity than they ought to have normally. So what we've seen in the deleveraging process is the retracement all the way back to the breakout level at 40 when oil came out of this 24-year consolidation, representing another one of our major structural reversals, not to have been seen since 1982, and has now achieved perhaps a more gradual rate of ascent. had a nice consolidation here in the 60s and 70s, and now you've broken out to 80, and ideally you'd like to see it move rather slowly from an economic perspective as well as from a technical perspective.